Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. There are a lot of headlines, markets are moving, so let's get right to what we're paying attention to here at Blanke Schein Wealth Management. Thanks for watching. So markets are up big today in the heels of yesterday's Fed meeting. Now on Tuesday, I reported basically my video update of the day, setting the stage for Wednesday, which was yesterday's Fed meeting and the FOMC meeting, and led by Jerome Powell, the Federal Reserve Chairman. Basically was in the middle. He was more hawkish than dovish, and hawkish in the sense that they basically said that the Federal Reserve needs a little bit more information, but they're prepared to act as soon as November. There's a lot of data coming in. Now, if you recall, the Fed has a dual mandate, meaning they have to pay attention to two things right now, and it's always been the case, which is employment. They want to make certain the U.S. economy, all the way down to everyone that wants a job can get a job, doesn't matter demographics or geographic location. They want to make sure that the economy is super healthy, super strong, and that everyone out there, if you're looking for a job, the economy can support that. And we're getting there. We're actually on the right track as it relates to that. So that's the first sort of part of the dual mandate of the Federal Reserve, why they exist, if you will. So they want to make sure the economy is growing so everyone can have employment, right? The second thing is inflation. So again, the Federal Reserve will allow inflation to run hot or get higher than than normal, simply because it would basically mean that the economy is growing and expanding, and they'll afford that. Well, they'll let that happen, because that just means that then they're actually going back to their first and foremost focus, which was employment across the spectrum. That being said, we're seeing inflation, we're feeling inflation, but we're also seeing a growth scare. It's called stagflation, and stagflation real quickly is just this, is when prices go up as the economy is growing, and then prices come down, but then inflation or prices stay up, but the growth is coming down, So the growth is coming down. So we're seeing a deceleration in the third quarter GDP, and there's a lot of factors to that. The COVID variant, which is slowing down, let's say, just the sectors of the economy. We can think of, let's say, travel, right? Leisure and travel has slowed down as a result. So that's a number that's going to slow the growth and the component, if you look at it, in the GDP in the third quarter. Another is a supply constraint, right? Right now, off of the coast of Long Beach, we've got about 70 tankers that have just goods and services that are just sitting off the coast of the United States, ready to come in, work their way in, but they can't work fast enough. So that's another issue. Those goods and services can't get in the economy. Again, you can't have those retail transactions. Those numbers will then not work their way into the growing sort of GDP. Again, our GDP now is about 19 trillion plus. But in the third quarter, we could see it down to 2%. Again, last quarter, we had plus 5%. So the GDP is shrinking a little bit, but inflation is still there. We're seeing inflation on housing. We're seeing inflation on gasoline, right? Up 42% year over year. Inflation on everything you and I spend money on, I would only imagine, right? Healthcare is up, education's up. All of these sort of inflationary numbers are up there, and now the growth is coming down a little bit in the third quarter. So that's called stagflation by definition. Now, the Federal Reserve is not too worried about that. They say it's transitory. They say it'll work its way out over time. That's a wait and see sort of predicament that we're going to be in. In the meantime, I'm going to talk about this in our Friday Insights a little bit further, which is, do they have a mysterious third mandate that the Federal Reserve has never admitted to, that they never will, technically they're not governed by, they don't have it in their sort of constitution, they don't need to do this, but in the investment world, we're beginning to wonder, with all this stimulus, with all this support, with all this sort of dovishness, masked with sort of a hawkish tone. It's kind of like mom and dad sort of still letting, the child, if they weren't doing good, great in school and they didn't produce what they said they would, but they're still going to let them go to the dance, or still let them go to the football game, or still let them do something that they really shouldn't be doing, because they're mom and dad and they come to compromise. So we'll talk about that tomorrow, what the third mandate potentially could be for the Fed. In the meantime, there's the stagflation scare, which is important to keep an eye on. We don't believe it's going to be a huge issue, but we're paying attention to it right now because it could turn into a major issue like it did in the 70s. And finally, the White House is preparing for a slowdown a stall in the talks. This is not new. It doesn't really matter if all the three branches of Congress or Washington are in sort of one camp or another. there's always going to be the horse trading. There's always going to be the concern about spending too much money or literally too much in the bill that shouldn't be in the bill, which we all know. We can all agree that we could nitpick the heck out of it if we wanted to. And literally there's a lot of stuff that shouldn't be in there. And that's what they're doing right now. The challenge that we're seeing right now in the 3.5 trillion, sort of just the headline, obviously we know it's way more than that if and when it gets passed, is ultimately the political capital from the White House is waning. And that means that, again, there's a lot of political clout that the White House holds, the president, if you will, in terms of negotiating this through. So what's going to have to happen, because the debt ceiling is really on our doorstep. And if we don't have the ability to basically call the credit card company and say, hey, can you increase our limit because we're exceeding our expectations in terms of spending right now? Oh, but we're good for it because we're United States of America and we've got the highest credit rating out there. But Mr. and Mrs. Credit Card Company, which is us, can you increase our limit so that we can spend more, just to get us to the next time that we need to have you increase our limit so we can spend more? That's the easiest way to think about it, is that they're just literally going to the credit card company, which is the world, and asking for more money by printing more treasuries and ultimately increasing our debt and exceeding our basically our credit limit, our ability. But what's the take-home point there is, we've done this before in the past, and it could be a concern that if we don't sort of extend or increase the debt ceiling, that then would shut down the government or the federal government, that would stop us making payments on some of our potential debt, which then could be a downgrade to the U.S. debt. We've seen this before. I'd like to say we've never done this before, but unfortunately we have. And that causes major ripple effect into markets. Now, do we think, especially with all three branches of government sort of in the same camp, that they can sort of get this through and make this happen? One would say, just common sense, yeah, if you can't get this done now, then you really can't get it done at all, which is a major concern in the financial markets, both here but globally. So we'll monitor that situation. I think something's going to be done late, last minute horse trading, as always. But again, the Federal Reserve's there, ready, willing, and able to help with all of their tools in the toolbox, as well as Treasury Secretary and a few others. Janet Yellen's out there as well, sort of working and negotiating, sort of navigating through this process in Washington. So those are sort of the updates today that are moving markets. Markets, again, like the Federal Reserve announcement yesterday, but also knows that the Fed is there in case the market has sort of slower growth. And so what that means is that markets have a relief rally the last couple of days, and now the indices, like let's say the S&P 500 most notably, is above the 50-day moving average. From a technical perspective, when it closes above that, that's a very good, healthy sign. So we want to see if we can continue this into the weekend. But again, we're constantly monitoring and taking advantage of it when opportunities present themselves for our clients. Thanks for watching and have a great day, and tune in next time. Take care.